Welcome to the Great Canadian Comeback, where we break down the stories, trends, and shifts happening across Canada and the moves people are making to stay ahead of what's coming next. Welcome to another episode of the Great Canadian Comeback podcast. So today we're going to be jumping in and talking about something that just happened recently, and that's the Bank of Canada holding interest rates at where it is. And we're going to talk about what's going to happen, how that's going to affect different parts of the economy, how that's going to affect the housing market, what exactly is Bank of Canada thinking right now in terms of where is the economy heading here in Canada, and why exactly do they want to be holding interest rates rather than slashing them and maybe boosting the economy in some sort of way. So let's take a look at what the Bank of Canada said themselves on their website. So let's take a look. I'm going to share my screen here, and we're going to take a look here. So basically, this is the Bank of Canada website, and what exactly we're going to take a look at is their press release and what they kind of determined is happening with their monetary policy. So Bank of Canada maintains the policy rate at 2.25%. So basically, the Bank of Canada today held its target rate for the overnight rate of 2.25%, with the bank rate at 2.5% and the deposit rate at 2.2%. And Canada's economy is showing signs of improvement. Growth is picking up, and inflation is projected to ease gradually from its recent spike. There are still important risks and uncertainties related to the war in the Middle East and the U.S. trade policy. So I just want to jump into one different other aspect of this where they're talking about where's Canada's GDP and data and what they're kind of expecting to happen. And what they're looking to kind of see happen over the next little bit. Basically, right here, Canada is saying, the Bank of Canada says, following the GDP growth of 0.7% in 2026, which was quite terribly and low, the bank projects the economy will grow by 1.8% in both 2027 and 2028. As the recovery proceeds, economic slack will be gradually absorbed. And what we're kind of looking at is where things are going to be heading here with the bank and what the interest rates are kind of letting us know and what's going to exactly happen. So if the Bank of Canada right now is holding rates at 2.25%, and they're predicting that the economy right now with GDP was only at 0.7% growth for 2026, which is quite terrible from comparing it to many other countries, we're going to be looking at what exactly is going to happen moving forward. Now, if they're projecting that GDP will change to about 1.8% in the future, now that's a substantial growth. Like if you look at basically, if it's at 0.7% right now, and we're going to be going to 1.8%, that's more than double. So it's almost like basically like 2.5 times what the growth is right now. So what that means is down the road, the economy looks great. The future for Canada looks very good right now because a lot of the investments and infrastructure that they've invested in, and they're starting to propose a lot of new policies in terms of like housing, in terms of investing in like oil infrastructure and things like that. They're not going to exactly happen overnight. These are massive investments in construction and manufacturing and build out. This is going to take some time to start happening. And then what's going to happen is obviously there's going to be a ton of job growth and things like that as well. So once you start investing in these sectors, we're going to see a lot of this start to unfold over the next little bit and what's going to happen. So if there's investment happening right now and there's policies changing in terms of saying, okay, we're going to invest in gas, we're going to invest in like LNG and things like that, it's going to take some time for it to actually develop. And that's why the Bank of Canada right now is stating, okay, we're going to be looking at major growth probably in 2027 and then carrying forward into 2028. Now, if the GDP starts to grow at 1.8%, obviously the rest of the economy is going to pick up. Again, we're midway through 2026 right now, and the beginning half of 2026 showed very difficult times in terms of GDP growth. and where things are at right now in that part of the market. So if it wasn't growing in the earlier part of 2026, then we're going to see substantial growth down the road, and we're going to see more from what the Bank of Canada is saying. So I'm going to jump back into the article so we can kind of see what else they're kind of stating here. Now, I just want to take a look right here. So basically what it's saying is, since the April monetary policy report, global economic prospects have been dented by higher oil prices stemming from the Middle East conflict, sorry. And at the same time, the build out of artificial intelligence is supporting economic activity in a growing number of countries. Oil prices are still lower than their peak in April, but the situation in the Middle East remains volatile. The path for global inflation is highly dependent on how the conflict unfolds. So what they're saying is, because of the conflict that's happening in the Middle East, the war with Iran, and how it's disrupting global oil flow, global production and oil coming out of that Strait of Hormuz, that's causing a lot of inflation because people are paying more for oil, they're paying more for gas, so transportation of like groceries and things like that is getting more expensive, which means at the end consumer is going to be paying more because of all these costs that are happening out there. Now, this is one important part we want to look at. It says the U.S. economy is growing at about 2.5%. And that's compared to our economy at 0.7%. So it's substantially higher. It's almost 3 times the growth of us, if not more. Now, it's mostly because of strong consumption and booming AI investment. China's economy is expanding solidly thanks to robust exports. Economic activity in the euro area has been weighed down by high energy prices, but is expected to strengthen in the second half of the year if energy prices come down as anticipated. So what we're kind of seeing is the U.S. economy is doing very good right now, and they're a consumption-based economy. They're the number one consumer in the world. Hence, being our neighbor to the south, if we got the number one consumer in the world, our next door neighbor, exporting a lot of things to them makes a lot of sense. And if we're looking at China, it says here basically they're one of the number one exporters in the world. They manufacture and create a ton of stuff in that country. Now, how does this kind of play out for Canada? Well, it plays out manyfold in a bunch of different ways. So, for example, we live next to the USA, which is the number one consumer in the world. They consume the most amount of exports worldwide. So if we live next to the number one consumer, we need to figure out a way how we can export more things, more stuff that they need so that we could make some money based on their consumption. It's kind of like when you're with somebody and you're out there shopping and someone's looking to buy, I don't know, let's say a pair of shoes. Now, if they got the money in their hand and they're looking to buy a pair of shoes, they're going to go where they can find, a massive selection of a pair of shoes. So, for example, for myself, if I was going to go to like a Foot Locker or something like that, there's going to be a lot of choices to pick from all sorts of different athletic shoes, basketball shoes, running shoes, this, that, and the other. Now, if the U.S. is that type of consumer, they have the money, they're the number one consumer, they're buying up most of the world's exports, and we live next door to them, it only makes sense to start exporting a lot more to them of what they want. Now, I know a lot of situations happening right now with the tariffs, and there's a lot of politics at play in terms of leadership on both sides, on the U.S. side and on the Canadian side. But once this all levels out, which it definitely will sometime soon, if we look at our history, being next to the U.S., they are the number one consumer. And what do they consume? Mostly from Canada is like oil, softwood lumber, some of the minerals and things like that. So the great thing is Canada is investing back into these areas. Definitely on the oil side, we're going to be getting a lot of new pipelines in place, sending a lot more out into not just to the U.S. Now we're starting to diversify as well. We're looking at other consumers out there. So For example, China. China is the number one exporter of the world. So they export the most amount of product into the world. But in order to be an exporter, you definitely need to import a lot of materials to create products so that you can export. So they need to be importing certain things like to keep their manufacturing plants going. They need oil. They need like energy. They need minerals. They need things like that to construct and manufacture a lot of these goods. So they need to be importing a lot of material and things like that in order to export the amount that they're looking to do. So if they're importing and they need some minerals, they need some gas, they need some oil, they need all these kind of things. That's why Canada has made some alliances with China. They're looking to basically get some other buyers in place that will be buying some of our exports. Because right now, yeah, we're getting pretty taxed heavily with tariffs and things like that from the US. And we've solely actually relied on the U.S. mostly as our consumer. I think the number is like 80% of our goods were going directly to Canada. Now, if 80% of our 80% of our goods were going directly to the U.S., so if we're dependent on one buyer and that one buyer is like, hey, you know what? I'm not going to be buying as much from you guys, or, you know, you need to lower your prices and things like that. You're kind of screwed in that situation because you're dependent on one party to be buying your goods. Now, what Canada has done is now they've kind of diversified. They've talked to a lot of the Asian Pacific countries, China, India, some of the biggest players out that way to be, okay, we're going to export a lot of our goods and energy out towards them so they can be one of our buyers. We're making some alliances with Europe as well and have them as one of our buyers as well. But again, we don't want to cut ties with the number one consumer in the world, who's always going to be one of the biggest consumers out there, and that's the US. But at the same time, if we diversify a little bit and don't be fully heavily reliant on the US, it's going to work in Canada's favor. This is not something that's going to happen overnight. This isn't something that's all of a sudden going to take place and the next 6 months, okay, everything's all set and good. But this policy and this outlook is a massive for Canada. It's going to really bring our economy to the forefront, because now what we're going to be looking for the next 5-10 years, we're going to have a lot of partnerships around the world. We're going to be partnered with massive countries like China, who have like almost the number one population, and with India. You know, the India and China are either one or two in population in the world. And if we're partnered just with those two countries, which is India and China, as as some of our buyers, we are going to be in a fantastic situation. And then just geographically being next to the US is going to be it already has been a big benefit, but it's going to be even a bigger benefit as the years go on. So the outlook for Canada looks exceptionally well for the next 5-10 years, because now we're making alliances with other countries, putting together some great trade agreements and things like that, which are just going to be massively beneficial for us moving forward. Now, with that being said, we got the US right beside us. If we settle down, make some good negotiations take place, if we not only have access to the US, we also have access to Mexico right below them, which is also a massive consumer in the world as well. They got a big population. You know, they're not consuming at the amount, obviously, that the US is. And a lot of people wonder, okay, why is the US such a massive consumer? Well, first of all, they have the money. They have a ton of money. They make a lot of things. They got AI production. They got a lot of tech that comes out of that country. They got the most wealth and the richest individuals concentrated in one country. So they have a ton of money and consumption power. So that's why we can easily sell to them and make them one of our best customers that they possibly can. And right now, what's happening? You know, a lot of people are a little frustrated and things like that. But at the end of the day, the buyer is who's dictating the terms right now, because they got the power, they got the money, they can dictate the terms to the seller. So how this works in the real estate market, for example, The real estate market here in Greater Vancouver has been a buyer's market for the last few years. Now, the reason being is because the buyer is the one that dictates the terms because they have the money to purchase right now. So if they got the money to be purchasing real estate, let's say, for an example, they want to buy a house and a buyer's approved from the bank, they can go in and negotiate with the seller. Now, the seller can be frustrated and be like, well, no, I'm not going to sell it for this much, or well, I'm going to wait for the market to recover, which is something we've seen with a lot of clients that we're dealing with, let's say 3 years ago. 3 years ago. They're like, well, we're just going to wait. The market's going to come back. This is Vancouver. We're not worried. Well, what's kind of happened from the last 3 years to now is the market slid 30%. So a lot of homeowners have seen almost a 30% reduction in their home price. So let's just to put that in perspective, $1 million home has come down $300,000. So now it's looking at about a $700,000 home. It's not a million anymore. And these are clients from 3 years ago. And now they're like, oh, wait, we need to sell our property now. But now it's worth 700,000. And 3 years ago, when you were getting offers at around a million, you're like, no, we'll wait. We want the market to recover so we can get more than a million. Well, it's not worth that anymore. It's actually worth 700,000. And the buyers that are getting the money to buy these types of properties are approved for mortgages. So they're able to buy these properties with that 700,000 because they're getting the lending from the bank. So how does this relate to like the Bank of Canada and kind of what's happening? So the Bank of Canada held its interest rate. And now what's happening is there's a lot less buyers out there as well because a lot of buyers were waiting for interest rates to be cut. And they're like, well, interest rates are going to be cut soon. That's when we're going to buy. Well, the Bank of Canada did not cut rates. And to go back to the scenario of the US and Canada, if the US is the buyer and Canada is selling and Canada is saying, no, we're not going to sell for this price. We want to be paid this much. Well, those were yesterday's prices or 3 years ago prices, just like homeowners are thinking. Sometimes you got to go with what the marketplace is saying and go with what the buyers are able to do. I know it's a tough situation, and a lot of people look at it, well, it shouldn't be this way. Well, that's what free market capitalism and free markets do. They go up, they go down, they go sideways, and depending on what market you're in, you're going to see a lot of these fluctuations, no matter what market you're in. And and right now we're seeing it in the real estate market. And a lot of people are shocked. A lot of people, did not see this coming. A lot of people that bought in 2021 and 2022 have literally lost all their equity and they're negative on their property. They owe more than the property's worth. And their monthly payments have gone up because back then interest rates were extremely low. And now interest rates are higher. So they're getting refinanced and new mortgages at higher interest rates. So their payments have gone up, but their prices have gone on their value has gone down. And that's kind of something that we're seeing on the global marketplace, right? So what's kind of happening in the global marketplace is a lot of supply issues and prices have either gone up in some scenarios, like we're seeing in inflation, because we're seeing a lot of the prices with gas and things like that being affecting inflation price. And we're seeing a lot of it in terms of trade and tariff wars and things like that, because certain countries have the buying power, other countries are the sellers, and they're not seeing the same type of situation. For example, like with China, China's exporting a lot of goods. And if they don't have the buyers out there for the goods that they're exporting, they're not going to be importing and buying any more, like not as much minerals and gas and things like that from other countries to support their economy. So when we're looking at this from a macro standpoint of like what's happening in terms of like the global economy, in terms of these situations, this also happens at a micro level, and that micro level is what I'm talking about in terms of what's happening in the housing market. And if you want to go even smaller than that, you can look at like retail. What's happening in the retail space? For my example of what I'm talking about with shoe prices. If somebody's going out there to buy shoes, are they looking more for a sale item now rather than paying full price? Or are they looking at maybe buying last year's model rather than this year's model because they save a little bit of money? everyone's looking at things from a perspective of what's going to do the best for them, how it's going to stretch their dollar, and how is it going to work. But again, from a Canada standpoint, we're looking at it where we are at right now, and just going off of the website that I just jumped on, thebankofcanada.com, we're looking at what's happening right now. They held interest rates, and they're holding interest rates because they're saying inflation is not totally under control because of what's happening in the Middle East. And they're holding interest rates because they're saying, the economy is not strong enough right now, so they can't cut interest rates. So they're saying all these different factors because they're basically stating we can't cut interest rates yet because of XYZ, what's happening in the Canadian economy. Now, to look a little farther down the road, what's actually happening in terms of GDP? Well, if GDP was only 0.7 for 2026, and they're predicting in 2027 and 2028 to grow to 1.8%, that means the economy is going to be growing substantially, more than double. So at least almost two and a half. So if we're going to be growing at that level, hopefully it's even more than that. That's just the expected rate. If it grows at that level, that means there's a lot of excitement and the future looks really bright. And if there are some factors in place like cutting interest rate, changing some other regulations and policies, this could look really, really good for Canada in the future. So this is just something I wanted to recap today, was where the interest rates are at, how it's affecting not just us locally here in Canada, not just the housing market, how it's affecting the economy, how it's affecting other factors in place. That's kind of what we're looking at in terms of where the marketplace is at and what's happening with interest rates. And if we have a little bit of a crystal ball and we could see what's happening down the road, and we can go by what the Bank of Canada is saying, they're basically saying once like oil prices level out and then hopefully things settle down in the Middle East, we can see interest rate cuts coming soon. We can already see our economies growing down the road. So the future does look very bright for Canada. If you're looking at where things are at right now, it's only up from here. So again, thank you for listening to another episode of The Great Canadian Comeback, and we'll definitely be coming out with some more episodes and talking about what's happening in the news, how it's going to affect the economy, and where Canada is heading in the future. Thanks for listening to The Great Canadian Comeback. Follow the show for more episodes and check the links in the description for more information. We'll see you next time.